SCHD has been one of the most popular dividend investments over the past few years. But with rising interest rates, market shifts, and a few cracks in performance, is it still a smart buy in 2025? Let's break it down and help you decide if SCHD still deserves a spot in your portfolio. SCHD stands for the Schwab U.S. Dividend Equity ETF. It focuses on high-quality U.S. companies with strong dividend histories and solid fundamentals. It holds about 100 large-cap stocks, and it's known for being low-cost, 0.06% expense ratio, dividend-focused, 4% plus yield as of early 2025, and super popular among long-term, passive investors. Companies like Pepsi, Verizon, Merck, and Texas Instruments are all in the mix. In 2024, SCHD saw some underperformance compared to the broader market. Tech-heavy ETFs like VOO or QQQ outpaced it. That's because SCHD is heavily tilted toward value stocks. And value stocks haven't exactly been winning lately. But that's not necessarily a bad thing. Remember, dividend ETFs shine over longer time frames, especially during market turbulence. One of SCHD's biggest selling points? The dividend. As of now, it's yielding about 4.2%, which is great compared to the S&P 500 or a savings account. It pays quarterly dividends, and its 5-year dividend growth rate is strong, around 12% per year, even when price returns were flat. On top of that, it screens for high return on equity, consistent earnings growth, and strong dividend sustainability. It's not just high yield, it's quality yield. Of course, no ETF is perfect. SCHD is heavily exposed to sectors like industrials and financials, light on tech, which has been the growth driver in recent years. And it's not very diversified globally, it's all US stocks. If the market continues rewarding high-growth names, SCHD might continue to lag. Also, a few top holdings, like Verizon, have been struggling fundamentally, and that could drag the fund. Here's the bottom line. Buy SCHD if you want. Reliable dividend income. Low-cost passive exposure to value stocks. A long-term core holding for retirement or income. Avoid SCHD if you're looking for high-growth exposure. Global diversification. Aggressive returns in the short term. It's a steady, conservative play, not a moonshot. SCHD may not beat the S&P 500 every year, but it's still a strong core ETF for dividend-focused investors. In 2025, it remains a solid buy, as long as you know what you're getting. As always, this video is for educational purposes only. Always do your own research and consult with a financial advisor before making investment decisions. If you found this breakdown helpful, hit that like button so YouTube will show this to more beginner investors. It really helps small channels like mine grow. Subscribe to Opportunity Odyssey for clear, no-hype investing advice you can actually use along your investing journey. And let us know what you think of SCHD here in the comments.